Welcome to our final session for Module 7 on good governance in local government. Today we shall be going through an introduction, first and foremost, on the good governance in local government. However, we'll be also going into further detail into the specifics that we have covered in the previous 3 sessions that we had altogether in the various localities in Malta and Gozo. So, we can start off with defining the concepts that we touched upon in our modules before. So we had four concepts: the concept of government, the concept of governance, good governance, and governability. As we now are aware, the 4 don't mean the same thing. They have distinct meanings. However, they're all connected and interrelated one to another. The government is dealing with the institution. Governance is the process of how those institutions are actually run. Good governance is taking the bar one level further in terms of governance. And governability is how legitimate that government or the institution is in actually governing the operation. In Module 7, we address these 4 concepts in the light of local government. So let us start off with a short clip on what governance is all about.
You hear the word governance a lot these days, but what does it really mean? And is it as important and serious as it sounds? Board governance or corporate governance simply refers to the job of a board of directors. Now, if you look at the position boards hold in corporations, you can see that they are sandwiched between shareholders or some kind of ownership on one side and the CEO and staff on the other side. Since the ultimate authority for the company or organization comes from the ownership, naturally, the governance job of the board comes down to 3 things. 1, have ongoing dialogue with the ownership to discern their expectations for what results the organization should produce. 2, translate those expectations plus other information and the director's own perspectives and values into written criteria for success. And 3, check to see that those criteria were met. In a nutshell, that's it. Board members can do other things, like volunteer to help staff or get involved with fundraising or public relations, but the board's core governance role is ownership linkage, policy making, and monitoring policy compliance. Now, you can see why governance is so important. The job of the board is at the front end of what happens in organizations. Sometimes a really strong CEO can compensate somewhat for a weak board of directors, but for any organization to truly live up to its potential and achieve relevant results, good governance is critical.
The definitions are also coming through the various institutions that we have internationally. One of them is the definition by the World Bank. It's a definition which we also addressed during the module, but is quite central to what we're actually dealing with in terms of our module. We're talking about the predictable, open and enlightened policy making, which in other words is the transparent process by which an institution is actually run. The other element within the definition of the World Bank deals with bureaucracy, and bureaucracy not in the negative connotation in terms of stereotype that we usually attribute to it, but bureaucracy in the sense of the processes and controls that are actually essential in the process of good governance. The third element of the description of the World Bank focuses on the executive arm of government being accountable. And not only throughout Module 7, but throughout all the 8 modules that you have covered, accountability has played a very central role in all of the dealings that you have been going through. The 5th element, and part of the definition of the World Bank, deals with the participatory approach that civil society has within the public affairs and also in the context of the local community. And finally, all of this has to be done within the concept and the parameters of rule of law. So, in Module 7, we went through a number of modules which our learning outcomes were that of looking into the fundamental principles of good governance, We also looked at how corporate governance in terms of external regulation can actually be internalized within the structures of the local government. We also looked into the international perspectives and the EU perspectives of how good governance is dealt with. We came to deal with the very critical element of rule of law, and today we'll elaborate further on the concept of rule of law. Tied to it is the element of democracy, where it is not necessarily the case where you have rule of law equals democracy or democracy equals rule of law. However, the two move hand in hand. We also looked into a key principle of good governance, which is that of how to manage risk, how to plan for it, and we will elaborate even further in this session today on the element of risk. Then we finally looked into the institutions and the law that enable us to have better governance within the local government framework. There are three main pillars that deal with Module 7. These are the good governance principles, the key role of risk management in good governance, the fundamental characteristic of law, and the rule of law as a third pillar, and all within the context of having also structures that can actually support good governance in a local governance framework. So, we looked into the good governance principles, and we have three main elements which we addressed. The element of the universal governance principles applicable to local government, and there we addressed 8 principles. The good governance principles which come out and stem out from the Council of Europe, which highlighted 12 principles, and that of what we look into the good governance practices within the Code of Good Practice of Local Government published by the Office of the Prime Minister, where there we dealt with 13 principles. So, let us go into further detail on the universal principles of governance. We have 8 main universal principles, that of having proper roles and responsibilities clearly defined, that of having a clearly defined purpose in the way how the organization is run and for what it is actually meant to be doing. In the case of local government, obviously, providing a service to the community. The third element was risk recognition and risk management, and this we will deal with further on. Having an appropriate management approach so as to ensure that the way how we're managing the organization, in our case, local council, has all the best practices in terms of management. The fifth aspect was how to actually optimize our operational performance, even in delivery of our services to the community. The sixth aspect of good governance relates to legal compliance, the importance that everything that we do falls within the parameters of the law. The seventh related to integrity and accountability, and here on a local scenario, we have various elements of how accountability and integrity are actually measured. Code of ethics is just one example of those. And the final element is transparency and disclosure information. Transparency is a key aspect to ensure that not only you have it as a good governance principle, but also to show to the community that you're actually adopting good governance principles. We shall now move on to the next aspect of having 2 clips, one which will deal in some detail in relation to the principles of good governance by analyzing what corporate governance is all about. And the other aspect, the other video clip, will deal with corporate governance as a measure of corporate governance, where although the clip is relating to the corporate world, the business world, however, most of the principles that are adopted in corporate governance are equally applicable in our context as well.
Good governance is about the processes, systems, and checks and balances by which organizations or societies operate. Frequently administered by governments, good governance is conducted in a transparent manner, free of abuse, corruption, and follows the rule of law. Governance modes may be top-down, market-based, through public-private networks, or a mix thereof. Importantly, good governance needs to be about creating organizations and societies as living systems in alignment with nature, so all life will flourish forever. Take charge, be bold. What's your vision for good governance?
Hi, this is Dave. So in this section, we're going to look at something called the corporate governance. So, when talking about the corporate governance, there are particularly 3 issues that we're going to look at. So, we're going to look at an overview of the corporate governance. The first issue being, what is the aim of the corporate governance? And after we look at the aims of the governance, we are going to look at particularly 4 theories that underpins the corporate governance here. And after we look at that, we're going to start focusing on the best practices that most of the companies nowadays actually adopts, in order to have a good corporate governance showing to the investors, to the company. So let's firstly kick off by having a look at the first one, which is the aim of the corporate governance. So what do I mean by corporate governance? Is where we're going to govern the company. So that's what I mean by corporate governance. And the aim for that is where we're going to make the directors to work in the best interests of the company, of the shareholders, in other words. For example, I'm a shareholder. I employ you as the director to work for me. So for example, you're the marketing director. So you have to work in the best interest of me. For example, you cannot collude with the external customer to steal my money, You cannot do that, can you? You cannot create a particular fake customer and you pretend that you are dealing with business with that fake customer, but instead, that fake customer, the bank details of that customer is the same as yours. And hence, what you're going to do is you're going to pretend that you are the fake customer dealing with business and taking the goods with business and write off as the bad debt. You cannot do that, You have to work in the best interest of the shareholders. In other words, you have to help the company to make money. Yes? I employ you as the director. I don't want to see you stealing money, from my pocket. So that's what I mean by the aim of that. So we're going to follow the corporate governance best practices. So for example, we're going to split the role between the CEO and the chairman. We're going to set up the audit committee. We're going to set up a good internal control system to prevent any of this fraudulent transaction happening within the organisation. That's how we do it. But the overall aim of the corporate governance is where we're going to make the directors to work in the best interest of the company or the shareholders, if you like. And there are particularly 4 theories that we are going to be looking at today. So the first theory being agency theory. And after we look at the agency theory, we are going to be looking at the transaction cost theory. And then we're going to look at the stakeholders theory. And also we're going to look at the fundamental principles of the corporate governance. Okay, so let's kick off by having a look at the first theory, which is the agency theory. So, what do I mean by agency theory? It's simple as that. So, it is the small company here. The company is so small, and the shareholder would be the directors within the company. Not only the shareholder owns the company, but actually that shareholder runs the company as well. So that's from the small company's perspective, because the shareholder doesn't have much time to, doesn't have much resources, for example, doesn't have enough money to employ the external directors to work for him. But as the company grows bigger and bigger, as the big company, as you can see, lots of subsidiaries around the world, so that one shareholder may not have time to manage all those aspects within the organisation. What the shareholders now they would do is trying to employ a lot of directors to work for him or her. So directors, namely as the CEO, the Chief Executive Officer, the Finance Director, Marketing Director, and maybe in some of the circumstances, the Human Resource Director or Information Technology Director as well. So they're going to employ lots of directors to work for him, but because of the word called trust, I don't trust the directors I employ, because they're not my friends, they're not my relatives, they're not my family members, and even if those are the family members, maybe I lose trust on those persons, that is working for me. So that here's the case. Assisting me for the small company, the ownership as well as the management of the company will be the same to one person. But as the company grows bigger, there's a separation of the ownership and the actual management of the organisation. And hence, the agency problem actually arises. So, what do I mean by agency problem is what I mean by trust problem. Because I don't trust you. For example, after employing the finance director to work for my company, I'm afraid that the finance director will, create some of the creative accounting, trying to steal the money from the company into his own pocket. I don't want this to happen, but this is a problem. This is the agency problem. This is the trust problem. Because I don't trust that finance director. I'm afraid that the finance director will take out my money into his own pocket. So that's the agency problem. And then how we're going to tackle that agency problem is where we're going to pay for them the agency costs. Okay? Is where we're going to pay for them the agency costs. So, for example, if I'm going to employ directors to my company, I have to make the payment to them, I have to make the payment for them. So, for example, I have to pay for them salary, I have to pay for them the performance-related bonuses, for example. So, for example, if they have made $5 million during this year, I'm going to give you 2% of this $5 million as the bonuses to you. Also, I'm going to give you some benefit, going to give you a nice sports car, so for example. I'm going to give you the pension as well. So that's the payment I'm going to make to those directors. Another source of the agency costs is what I mean by monitoring costs. So, what do I mean by monitoring costs? For example, I have to follow the corporate governance, CG for short. The corporate governance principles or rules if you're in the USA, so for example. So if you're going to follow those principles or rules, for example, you're going to set up a committee, set up different committees required by the corporate governance code, that will be the extra cost for your company. So why are you going to follow the corporate governance? Because you don't trust the directors within the companies who has worked for you. You have to monitor their performance, making sure every action, every strategy is in the best interest of the company. So that's why you incur the costs. For example, the disclosures of the corporate social responsibility that the company has shown to the external investors, and that will be a cost for the company. Because if you were to demonstrate that you're ethically, you're ethical to the public, you are improving the environment, for example, you need to have certain procedures to try to reduce the emissions of the carbon dioxide to the public, so to the environment. So you're going to disclose that. So from that perspective, that will be a cost for you as well. Of course, audit fee would be another source of the monitoring costs. Because, for example, I employed the finance director to work for me, fine. Whether or not the financial statements prepared by that director is correct or wrong, of course we're not sure. Until we approach the auditor, it's up to the auditor, the independent auditor, to audit that financial statements prepared by the finance director, so that I can know whether or not that FS is true or false. Okay? So those will be the costs we incurred in order to deal with the agency problem. Okay, so that's the first one, which is the agency theory. Recap of what we've done. Agency theory arises because of the word trust. Because we lack of trust on those directors, arising from a situation where the separation of the ownership as well as the management of the company actually exists. So those will be the trust problems, and how we're going to deal with those problems is where we're going to incur the agency costs. For example, we're going to pay them salary, we're going to pay for them bonuses in order to motivate them to work for our company, in order to prevent them from stealing the money from our company. Also the monitoring costs as well. Okay, so that's the agency problem we just looked at. The second theory we're going to be looking at is something called the transaction cost theory. So, let me just write down here. And there's an interrelationship between the agency as well as the transaction cost theory. So let me just write down here. So, what do I mean by transaction cost theory? Is what I mean by we are incurring the costs when dealing with the transaction, either internal transaction or the external transaction. But what does that mean? So, for example, if you are going to build a website, are you going to find a company, find a supplier who is offering the website services, and then you're going to sign a contract with them in order for them to build a website for you? Or are you going to employ a person to build a website for you? So, if you're going to find a particular supplier that is going to build a website for you, you have to look for different suppliers. You have to argue the prices with them. And that takes time, and it's time consuming, and hence, of course, that will be a cost for the company. Yes? But if you're going to trying to employ a person to work for you, to build a website for you, you control this person to do that for you. You control the quality, etc., etc. And hence, of course, if you're going to make the second website or the third website later on, you don't have to search for another supplier if the first supplier doesn't perform really well. But rather, you can use that person to do those services for you again, so that you can feel more certain. Yeah. So this means that on the first one, if you're going to find a supplier to do that, this will increase the transaction cost of searching that kind of thing. If you're going to use the second option, surely that this would decrease the transaction costs because you feel more certain about it. But when I talk about the internal as well as the external, I'm talking about the employee within the company, and also we're going to talk about the outsourcing as well. So, before we dip into that any further, we're going to look at the sources, or we can call it as the components of the transaction costs. There'll be lots of components within the transaction costs, to be perfectly honest with you, but the two main costs that we're going to mention is that firstly, uncertainty costs. And secondly, opportunism costs. So, what do I mean by uncertainty costs for the first one? Is what I mean by if you're going to look for some of the supply that is going to be the website for you, you have to look for it. You have to argue the prices with them. So it's quite uncertain that you can look for such a good quality supplier. And if this is not the case, of course, you're going to find another supplier who's going to build the website for you again. That will incur you the extra costs. So, that cost associated with the researching. Because you spend time into doing that, and hence that will be a cost for you. Because you have less time to focus on the strategy of your company, because you spend most of your time looking for different suppliers that's going to provide you with the website design service. That's not good, really. Second cost is called opportunism costs. So what do I mean by opportunism costs is that, for example, this is the first time that the directors is working for you. This is the first time that the website designer is working for you. And this means, of course, it may be a chance for that particular designer to charge you a higher price, because this is the first time you work for him or her. So that maybe it would be a benefit, it would be an opportunity for that particular party to earn a benefit from you. So when we're talking about the opportunism cost, is what I mean by this is the benefit to another party. Another party may find that this is the opportunity to charge you a higher price, because this is the first time we work for each other. And of course, if we can work long term, surely I'm going to give you a discount. But since this is the first time we work with each other, I'm going to charge you a higher price. So that, of course, if that is the case, that will be a transaction cost for the company. Because this is the first time I work for you, I have to pay for you more. Okay, so that's the opportunism. But if you're going to look at the transaction cost from the internal as well as the external perspective, for example, talking about the internal bit, maybe there will be a benefit for directors who is new to a company, newly coming to a company, but directors may try to do some sort of creative accounting. So for example, why is going to do that? Because the directors want to earn a benefit for himself. And hence that will be an opportunity for directors to earn the money from the company. So that's increasing the transaction costs. At the same time, external bit. For example, outsourcing options. If you're going to outsource the website redesign to a particular supplier, maybe this is the first time you work with him, and then the supplier will charge you very high because they want to earn the benefit, So that by seeing this, both of them will increase the transaction costs. But you may have a question, well, Steve, so what? Well, if you're going to look back to the agency costs in the first one, which is the agency problem arises so that we're going to pay for them in order for them to work in the best interest of me, So that the link between the agency costs, agency theory, as well as the transaction cost theory, is that, for example, if you are going to increase the transaction costs, this means you're going to outsource it to somebody else to do that for you, rather than having this particular person to work for you in the long term. So if that is the case, of course, fewer agency costs may be incurred, because you're going to outsource it to someone else to do that for you, You don't have to pay for the salary, bonuses, etc., but rather pay for the one-off contract fee, job done. But let's look at the other side. If you are going to decrease your transaction costs, This means you want to feel more certain. First one, feel more certain. And second one, for example, you're going to make the directors within the company not doing the creative accounting. What you should do is to increase the agency costs, the cost of the payment to those directors, yeah, in order for them to stay within the company to work for you, rather than looking for other directors to work for you. At the same time, you're going to spend more money into the monitoring cost. For example, you're going to monitor that performance following the best practices according to corporate governance in order to prevent some of the fraudulent behaviours happening within the organisation. So that, as you can see, a decrease in transaction costs, which means the company wants to feel more certain, and hence the company will have to incur more costs into, sorry, this is the agency, into paying for those directors, into monitoring the performance of the directors as well. So that's the interrelationship between these two, okay? Another argument for that is, well, if you are going to decrease the transaction costs here, this means you will actually feel more certain about doing things. So for example, you've built a building rather than rent it for a short-term lease, but rather you're going to buy it on your own, and then you're going to buy the tutors in order to run the college. So for example, you buy a building, buy the tutors, buy the books. Of course, everything seems fine. You can control everything. But at the same time, yeah, this is less risky, yeah? If this is less risky, of course, the shareholder may not happy, because less risky will normally mean that this will be less profit. I cannot guarantee, but in most of the circumstances, less risky, less profit. The shareholders is unhappy about it, and surely those shareholders, what now this would do is to increase the agency costs. For example, allowing more non-executive directors to come into the board to discuss the issues with you in order for you to make more money out of it, yeah? Make more money out of the new strategy. So from this perspective, decrease in transaction costs, increase in agency costs. Okay, so that's the interlink between these two. So we finished off the first two theories, which is the agency theory as well as the transaction cost theory. And the third theory we're going to look at is called the stakeholders theory. So what do I mean by stakeholders theory is that the stakeholders theory arises from the agency theory. So let me just to point you out here. So from the agency theory, also it will lead to the stakeholders theory. So agency theory talks about trusts between the directors as well as the shareholders. The shareholders does not trust the directors, so that the shareholder will like to pay for them lots of agency costs, etc., incurring lots of agency costs. But nowadays that we can argue that if you're going to run a business, not only you're going to focus upon the person who put his money into a company, who is the shareholders, but also you have to look after other stakeholders as well. For example, one of the typical examples for the stakeholders is called the local communities. So we get the local high quality labour from the local community. But if we are not to look after the local community, for example, we're going to damage the environments, for example, and hence, of course, this is not good, because the local community will refuse to supply you with any high quality labour anymore, because you're damaging their wealth and also health as well. So that is not good. So that's why not only going to keep the shareholders happy by making as much money as possible, but at the same time, nowadays you have to look after the stakeholders. Also, you have to look after the government as well. Although you're going to you're going to breach the laws and regulation published by the government, and hence you're going to face the penalty. For example, $30, and that's not quite material for the company for the penalty cost, yeah. So that you're going to ignore it. But can you do that? Well, to some extent you can, but so, to some of the extent, you can't. Because if you're going to be in breach of the laws and regulations, for example, you're damaging your long-term reputation. Okay? So that's not good for your company overall. And hence, of course, when operating your business, not only are you going to look after the shareholders, but also you're going to look after other stakeholders. So what do I mean by stakeholders is what I mean by somebody will be influenced by your organization. Okay? So if you can influence some of the persons, such as the customer, supplier, local community, government, etc., you can name it. So that will be a stakeholder to your organization. So should we show the responsibility to those stakeholders then? That's another question. So now the question would be responsibility. Of course, the answer is yes, particularly in the modern business world nowadays. If we can turn that responsibility into the opportunity for the organisation to make more money. If we can demonstrate a responsibility to them, of course, surely we are going to look after them, yeah? Of course, we're going to tell you about how to demonstrate this corporate social responsibility later on in the section. So that's the third theory we just look at, which is the agency transaction costs versus the stakeholders theory. The final theories that we're going to look at is the fundamental principles that the organisations has to follow in order to have a good corporate governance within the organisation. So let's talk about the fundamental principles here. There are particularly 8 fundamental principles that we're going to mention today. So first principle being integrity. So what do I mean by integrity? Is that not only people will have to follow the ethical standards, they cannot lie to others. Also, according to the IFEX Code of Ethics, will have to be professional, will have to be competent, etc., etc. So we have to stick to that particular code. For example, we have to be ethical men. Not only are we going to do that, but also talking about the system. It has to be integrate. Okay? So, for example, how the system can be integrated is that the system is reliable. For example, if you're the shareholder, if you are going to invest your money into my company, but subsequently found out that there's not enough segregation of duties within a company, which means you put your money into my company, your money may be stolen by some of the employees within our company, and hence, of course, you're not going to invest your money into my company anymore, yeah, because you don't trust our company anymore, because our company is not integrate. Not only for the people it's not integrate, but also for the system it's not reliable. It's not operating your money. It's not to utilize your money to make more money for you, yeah, so that you're going to refuse to invest your money into my company. The second principle being fairness. So, what do I mean by fair? It's normally I say to my students, life is unfair. But how can be fair? Well, we are going to treat the stakeholders equally. So, for example, if you're a customer, you buy the courses here, I'm going to give you this discount, fine. But after I've given you, for example, 5% of discount, by subsequently you notice that I subsequently have given 50% of discount to another student. Of course, you're not happy about this, yeah? Surely you're not happy about this. And hence, of course, you may not be our customers anymore because you lose trust into a company. Because I only give you 5%, but I give another student 50%. So that you're not happy, you're not going to be a customer to our institute anymore. So that's what I mean by fairness. So we're going to treat a group of stakeholders fairly. That's the fundamental principles for the corporate governance. But also you can argue that, for example, you're going to show that you're ethical by trying to disclose your corporate social responsibility to all of the stakeholders. You're not going to hide the information into your company, but rather you're going to disclose this information to the public, making your company more transparent. And hence that will be the third of our fundamental principle, is called transparent. So what do I mean by transparency? Is what I mean by you're going to disclose the information to all stakeholders. But maybe to some extent that you can argue that if I'm going to disclose all of this information to competitors, of course it's not fair for the company, it's not good for the company at all, because the competitors may copy this information and would like to use this information to attack our company, for example, and hence that's not good. So for the transparency, we are referring to mainly for the disclosure part. For example, the chairman within a company should disclose the information of the company into the chairman's statement, and that statement should be transparent, showing all of these issues that is within the company, so that it may be fair for the shareholders to make the decisions of whether or not to invest their money into our company. Okay, so that's the third fundamental principles. If I'm going to follow those principles, of course that would be good. That would be good for our companies long term. Yeah, that's what I'm talking about. The fourth fundamental principles is called judgment. This means because we are the directors within the company, yeah, we build a system for the company. Why we're going to do that is because we want to make money for the shareholders. We'll put this money into the company. So that's why we build a system for them, and then we generate information from those systems. So the judgment means, from a director's perspective, we should have been given necessary information to make the decision. Okay, so that's the judgment. And also we talked about another principle is called property. We can call it as the honesty. So, I said to you, firstly we look at integrity, which means we cannot lie to others. But now I talked about the honesty. Also, I mean that you cannot lie to others. But here is referring to that firstly, you cannot lie to others. But secondly, you're going to have the solution. You're going to find out what's going on. For example, somebody is stealing the money from the company. For example, the accountant is stealing the money from the company. Fine. Because you're the CEO of the company, I'm the shareholder, so when I notice this issue from the company, because recently I went to the company and I noticed that somebody is stealing the money from our company by looking at this account. So I'm going to come to you, say that, CEO, have you noticed, do you know who is stealing money from the company? Because you don't know about it at all, yeah? This is a truth, so you're going to tell me that, I don't know, sorry, I don't know. But if you add, this is the full stop, this is not acceptable because you're the CEO, you're responsible for the overall system within the company. You're making sure that internal control system is sound, and hence, although you don't lie to me because you don't know about it, but if you haven't found out who is stealing the money from the company, etc., making sure that the internal control system is sound, of course, you're not honest. Yes? So that's what I mean by property or honesty. You can use the interchangeable word. Also, we're going to talk about something called independence as well. So, what do I mean by independence? Is what I mean by there should be a segregation of duties. There will be separate person doing things. For example, we are referring to as mainly for the auditor, for example. So, auditor is going to audit that the financial statements, whether or not they're true and fair. That financial statement should be prepared by the accountant. I can't say that the auditor prepares the financial statements and subsequently audits it. And surely, if the auditor is going to do that, of course, that will be maybe the familiarity threat, the self-review threat, for example, to objectivity. So, the independence is what I mean by objectivity. You can use the interchangeable word if you like. So this means we're going to use the separate person to do the things. Secondly, it means that we need to stick to the standards. There's no point that you prepare the financial statements not based upon the acceptable accounting standards in your country. Okay? If you're not going to stick to that standard when preparing the financial statements, this means that your financial statements will be wrong, and hence it's not independent. Means this is not trustable. You can use the interchangeable word if you like. Independence is what I mean by objectivity. It's what I mean by trustability, or you can call it trustable. Whether or not it can be trusted by the shareholders within a company. So, because if you stick to the standard, you're independent, because you're the person who audits the financial statements, who prepares the financial statements, not necessarily the person who sets the standard. So that, of course, the financial statements you're going to prepare for, if it is fulfilling the standard, if fulfilling the accounting standard, of course, that will be trustable by others. Okay, so we talk about integrity, fairness, transparency, judgment, honesty, independence, and the final term I'm going to talk to you about is the accountability, as well as responsibility. So, what do I mean by accountability? Is what I mean by a word called promise. For example, the directors is accountable to shareholders, promise the shareholders to make $500 million during the year. That's the accountability of the directors to the shareholders, because I promised you to give you $500 million. And then I'm going to delegate this accountability into different responsibilities. This means, who is going to make this $500 million? Of course, I'm going to delegate, for example, to marketing department. You have to start up a project and have to make maybe $400 million for me. And then I'm going to delegate the finance department another $100 million for me, because please invest my money within the company into some of the short-term securities, etc., to earn the extra income for our company. So I'm going to delegate this promise, this accountability into different responsibilities to different departments within the organisation. Okay, so that is the difference between these two. And normally for the accountability, it will be presented into the account. For example, chairman, chairman is responsible for the shareholders. For example, I'm going to be I'm holding accountability for you to give you $500 million. I'm going to take this down into the chairman's statements, for example. So that's one way that we can demonstrate the accountability here. Okay. So that's it. So those are the fundamental principles behind the corporate governance. It simply means if we are going to follow those principles strictly, surely that the corporate governance of this organisation is good. And if the corporate governance of this organisation is good, and surely we can make more money for the shareholders. And hence, of course, we can attract better investment from different shareholders outside the organisation. Okay, so that is the aim of the corporate governance as well as the theories of the corporate governance. And the third thing we're going to look at in this overview of this paper is where we're going to look at the best practices as well. So how we're going to make sure that the corporate governance within the organisation is good or bad, we're going to follow the best practices. I always say to my students that there would be 5 best practices that we're going to follow, nothing more. Okay, so the third one being we are going to define the board of directors as well as the roles of each of the directors, making sure that the directors, including the executive as well as the non-executive directors, are working within the best interests of the company. Also, we're going to look at different types of board in the third section later on when we come to it as well. And secondly, not only we're going to set to these boards within the company, but also we're going to make sure that board is effective. They're actually working. So we're going to look at the performance of each of the directors. If they're performing really good, of course they can stay within the company. If not, they should leave the company, for example. And thirdly, we're going to look at how to build a good internal control system. So what do I mean by internal control system? It is the system to prevent something bad from happening and encourage something good to happen. For example, I need to have that internal control system in place. For example, if I'm going to buy a raw material to an organisation, one of the internal control procedure would be to get the quotation from different suppliers before you buy it. But you haven't got that quotation from different suppliers and you subsequently buy it, this means you're running a very, very high risk that the raw materials may not be in good quality and also the prices will be too high for the company to purchase. And hence, the internal control objective for the organisation is to make sure we spend less money to buy the good quality material. And hence we need to have this system, or the procedure if you prefer, namely, get the quotation from different supplier before we purchase it. So that's what I mean by internal control system. Of course, we're going to look into that in much more detail when we come to it. And also, for the fourth one, we're going to look at the payment to those directors within the organisation. And this is also what I mean by remuneration within the organisation as well. So, I said to you, in the first theory, which is the agency theory, is we're going to pay for the directors because we're going to incur the agency costs, such as the remuneration fees, such as the payment fees to those directors, in order for the directors to work in the best interest of the shareholders. Yes? And hence, in this particular section, we're going to follow the best practices according to the Corporate Governance Code. We're trying to say by how much we should pay for those directors, so the directors can be motivated to work within the best interest of the company. Also, what sort of components that we're going to pay for those directors in order for the directors to work in the best interest of the company as well. And the fifth one is where we're going to deal with the shareholders' relationships. Because the shareholders employ our directors to work within the organisation, and we have to communicate with those shareholders when not our company is operating effectively, whether or not there will be some of the problems occurring within the organisation, and have to give you notice, before it goes wrong. And that will be very, very important for the organisation as well. So we're going to look at those best practices in turn in the next of our section. So in this section, we finish off the overview of the corporate governance. We just talk about the aim of it and the theories of it, also the best practices overview of it as well.
The Council of Europe's Good Governance for Local Government is a framework whereby the Council of Europe, as part of the reform process of local governments throughout its member states, developed and articulated. In the next video clip, we shall be looking at, as a refresher, as to what the 12 principles are which were defined by the Council of Europe. The Council of Europe came up with these 12 principles which we have just listened to. The primary element of these principles are very similar to the universal principles which we tackled earlier on. In essence, one is saying there are 8, these are saying there are 12, but in reality, we're all dealing with the same concepts. Of particular mention is the interlinkage that there are between the 12 principles within the Council of Europe definitions of good governance and the applicability also in terms of governability. The 12 principles focus a lot on the participatory approach, on the elements which citizens expect from the delivery of local services, and this is something which is pretty particular to good governance in local government. Elements of optimal performance, like having efficiency and effectiveness in the way how you deal with your services, in the way how you deal with your clients, who in reality are either the people who live in the locality or the NGOs operating out of the locality, or as the businesses which are operating within that locality. Transparency is another element which we found in the previous principles, as also legal compliance, but an aspect which is also critical, which the Council of Europe decided to actually augment, is the element of having skills and capacity which are continuously improved. And this is an aspect which the Council of Europe has specifically highlighted as an important element in order to have good governance, because if you do not have the capacity, the structures, and the people who are capable of delivering the services in an efficient and appropriate manner and in accordance with all the other principles of good governance, then you do find an issue in actually enforcing good governance within your community. A key aspect as well, which the Council of Europe has also developed, was that of being open to innovation and change. We are living in a dynamic society whereby social media has become a pretty much predominant way of how people express themselves, even with the local councils, and the local councils expressing themselves with the community. It's a part of the evolution that technology is bringing about in order to be closer between the stakeholders. And the Council of Europe actually highlighted the importance of having the openness for this type of new technologies in order to deliver elements of good governance throughout the community. Accountability is also a key aspect which cannot be stressed enough. However, the element of having a sound financial management approach has a predominant view in the case of the Council of Europe's proceedings on good governance, because having sound finances is actually a deterrent for actually staying away or swaying away from good governance. And this is also what makes a difference between countries which do not properly adopt good governance principles because, for instance, they have elements of high debt, or else elements which, because the finances are not actually sound, leading to nepotism or corruption. So having a sound financial management approach is also very key in the delivery of services to the local community. Malta's principles on good governance have one element in addition to that of the Council of Europe, in terms of numbers at least, whereby we're talking of 13 principles. However, also as we discussed during our sessions, in reality, we can say that Malta's good governance principles focus around 12, because the 8th principle of corporate governance is just inserted there as an element to stress even further the importance of corporate governance, because the other 12 elements already encapsulate the elements of corporate governance. An important aspect which comes out, which is a bit slightly different from at least the way how it is articulated from the Council of Europe's principle of good governance, is the element of responsiveness, the elements of being timely in the decisions that we take as a local council, in the way how we deliver our services, in the way also how we respond to our clients, who are the people who are living within the community, whereby when somebody is coming and to approach the local council, they expect that they would receive a response to what they are claiming for. And that is an element which is very key and important, so as to have a closer interrelation with the people who are actually serving, which is the community. So, we've been through the elements of the principles of good governance. So, Module 7 actually went through the 3 pillars, and now we're going on to the central pillar, which is that of the importance of risk management and good governance. This is an aspect which cannot be underestimated. It's a role, it's a function which has materialized over recent years, especially within the context of public sector administration. We looked into the various aspects of good governance, and as you can see, one of the, from the highlighted diagram, there's the highlight on the risk management and its management. And over here, we need to realize that one of the key important things is that if you do not recognize risk, you cannot actually plan for it, and when it actually materializes, you cannot actually face it appropriately. So in order to manage your risk appropriately, you firstly need to recognize that risk. And there are various methods of how to go about recognizing that risk, which we will see shortly in our video clips. It is also important to realize that what you cannot actually recognize as being a risk, then you cannot actually deal with it. And it's an important aspect that has also come up in the evolution of policy making, whereby up to some years ago, the concept of risk management within policy making wasn't actually something which was given due importance. But events, international events especially, and even local events to a certain extent, have actually brought to the fore how important it is to address also risk management within the policy making. And this is also not coming only from the central part, but it also addresses all the policies that a local government would like to implement within its community. So, the recognition of risks needs to be framed within a certain aspect of understanding the definitions that are behind risk. First and foremost, risk is the propensity of a challenging or a negative outcome of happening. So it is the possibility of something happening, and therefore the importance of actually recognizing that there could be these outcomes and identifying them and logging them in as risks. The second element is risk probability. So what is the probability, the chance of that outcome actually happening? And this aspect of probability is key for us to identify, yes, there may be some risks, but how probable are these risks of happening or not? And this exercise helps us in the planning process of risk. And the third aspect is, what is the impact, the risk impact? So if there is a risk that can actually materialize, and it has a certain probability of materializing, but in reality, what is the risk impact behind that? What impact will it have? Will it be of a low impact? So it's something that within our risk planning we can take with a certain pinch of salt? Or is it something that can actually materialize, providing and causing a high impact on the outcome of a particular project, on the outcome of a policy, on the reputation of the council? So these are aspects which are, and definitions which are key to keep in mind when talking about risk. The recognition of risk and the management of risk has, over the last decade, taken a very predominant role in policymaking, as I explained before, but also in the implementation of the government programs. There are so many things that can go wrong when you're actually trying to implement a program. And it's so important to have the good practice of actually recognizing what can go wrong in order to plan, to have your plan B, your plan C, your plan Z. And that would assist not only in the terms of good governance, but it also assists in the delivery of the service. Finally, what actually happens in the context in general of risk management applies on the local level. And as I explained before, it is crucial that we understand what risks our council can face. Part of risk planning and risk management relates to crisis planning. And as explained during our modules, there's a difference between crisis by management or management by crisis and crisis planning. The reason being that you can actually plan out a framework and a structure as to how to deal with a crisis. And that would form part of your risk management plan, as opposed to having been hit by a crisis which you have not anticipated, which you do not have the structures in order to deal with. And then yes, in that case, you would have a management by crisis situation. The importance of having planning for crisis is a fundamental aspect in good governance. Why? Because if you do not plan for your crises, and if you do not have the appropriate structures in order to deal with a crisis, you are hit by the crisis unexpectedly, and in order to resolve that crisis, many a time what happens is that all the good governance principles that you have been adopting as a council would fall away, would be foregone in order to deal with that crisis there and then. And that obviously is not good practice, especially in terms of good governance. So the aspect of planning crisis is a key and important factor. The next two video clips will address the general overview of risk management, whereby we will have all the theory behind risk management, and we will go further into detail. And the second clip, which will follow that, will deal about how to plan for a crisis, how to structure yourself for a crisis. Both clips obviously deal with large organizations. However, you can very, very quickly grasp the concepts and think of how to apply them within your local sphere.
So, what we're going to do today is to look at the risk management. So before we dig into the topic of risk management, I'd like to tell you what is the risk. A risk is the possibility that you will lose your money. At the same time, you gain the opportunity to earn some money, isn't it? So suppose you have an opportunity, investment opportunity for you to invest your money into buying the factory in another country. So the laws and regulations says that if you buy this factory in the country, then you can create some sort of job opportunities for the employees locally, and the government will give you some sort of tax credit for you. Now this is the opportunity for you because you can save lots of money after buying this factory. But maybe you're running also a risk that after you buy this company, after buying this factory, you have no idea how to operate it, okay? You will end up losing a lot of money. So I told you, risk is a possibility that you will lose your money, but it certainly is the opportunity for the company to grow, isn't it? So if the company take on no risk, well, maybe the company will be very small. Right, so when talking about the risk management here, I'd like to talk to you two things. Firstly, is that what do we need to manage the risk? Secondly, is to talk to who actually manage the risk, okay, and how to do with it. So let's take a look at the first question, is that what do we need to manage our risk? Well, the answer is, it depends, okay? It depends on a number of factors. So suppose this is a company here, and it will depend upon the scale of the company and diversity of the company. So if your company is so large, okay, it's a multinational company, you're facing a lot of transactions, a lot of activities day to day, isn't it? So what you're going to do is to manage what would go wrong, okay, before you actually going wrong. Because after these activities are going wrong, what you're going to do is to end up paying lots of penalties in relation to that. The second factor you have to consider is the number of employees within your company. So if there are lots of employees within your company, maybe your company is a labour incentive company. So if that's the case, when they're trying to do the day-to-day operational businesses, they may try to make mistakes. Okay, so you're going to, from a company's perspective, you should be able to manage those risks of getting into failure by the employee quite well, okay, before they actually fails to do so. The third factor you have to consider is some sort of unexpected errors, okay, something you haven't seen before, okay, it's unexpected. So if that's the case, well, if there are lots of unexpected errors, which means, well, think about it this way, if you're entering into a new industry, you have no idea of what this looks like and how you're going to operate it, okay? If that's the case, lots of errors might pop into being, so you have to manage those risks, those possibilities that your money will lose out. The next factor you have to consider is when you're trying to buy another company, you change the management for that company, and the new management onto the new company will have no idea about the industry, about its operation. You have to think about the structural changes, and so what you're going to do is to manage the risks that the management may go wrong. lastly, what you're going to do is to, think about the new risks occurred, okay, the company is facing, okay, so and there are lots of risks, new risks that pop into being, so we have to manage the risks properly, okay, before it actually getting into failure. So the next question is, well, who does it, okay? Who does the risk management? I can tell you the real practice is that the risk management issues will be done by the audit committee. But in some large multinational companies, because their companies are so large and their audit committee has so many affairs to do, so what they're going to do is to try to set up a risk committee, okay? A risk committee is simply like the audit committee, including lots of non-executive directors, okay? The question I'd like to ask you is that, well, do we need the risk committee? Well, the answer is, it depends, okay? It also depends on these sorts of factors. So when the examiner is asking you, do we need a risk committee? Or what are the factors to be considered when trying to set up a risk committee? You are telling the examiner, it will depend upon the scale of the company, number of employees of the company, unexpected errors, new risks and structural changes of the company as well. Right, so the next question is that, well, for the risk committee, are there any composition requirements in relation to that? We will answer those questions later when we come to it. And the further question I'd like to talk to you, and it's your examiner's favourite topic, is that what are the roles of the risk committee here? Okay, there are basically 4 roles. Firstly is to identify the risk. Okay, identify the risk, what the risks the company is facing, what has the possibility that will make the company lose money. Secondly, what they're going to do is to assess their impact, okay, is to do something called risk assessment, okay. These risks might have a significant impact on the company, which means, well, if these risks were to happen in the real practice, maybe the company will end up paying a lot of penalties, okay. The significance is so large. The third role of the risk committee is to set up some sort of risk strategy, okay? How are you going to deal with it? And finally, is to implement and also monitoring the risk strategy they're going to choose as well. So what we're going to do first is to have a look at the composition requirements for the risk committee. Is that all the composition for the risk committee? Firstly, the directors within the risk committee should be independent, so that we should include majority of the non-executive directors who are the outsiders from the company, who are not involved in the day-to-day running of the businesses. Secondly, is that, well, these sorts of directors should have reasonably expertise, okay, of knowing what the company does and what the risks that the company is facing, okay. So for the directors who are involved in the day-to-day running of the businesses, they might have knowledge of what's going on. So for the directors who are outside the company, so such as the non-executive directors here, may have no idea of what the company is going to do, okay. So risk committee is going to do is to combine the executive directors and the non-executive directors here, because for the non-executive directors, they provide the trustable opinion. In other words, it's the independent opinion to prohibit the executive directors to try to take on some sort of risky, very risky strategies that might damage the company's overall financial health. Okay, so we have to include also the executive members as well. So this is the composition requirement for the risk committee. What we're going to do is to take a look at their roles, okay? What are the roles for the risk committee? There are particularly 4 roles for the risk committee. First is to identify what sorts of risks that company is facing, and then try to measure their impact and their likelihood as well. What we're going to do next is to come up with a strategy of how to deal with it. And fourthly, after we plan our risk strategy, what we're going to do is actually implement it into real practice and also monitor and review its results as well. So what we're going to do first is to look at the identification of the risks. So when trying to identify the risk then, there will be particularly two issues I'd like to talk to you. Firstly, is how you can identify your risks, okay? And secondly, what are those risks, okay? What type of risks there are into the real practice. So, how to identify the risks? Well, we can use PESTLE analysis. What is PESTLE? PESTLE from P3 study. P stands for the political factors, the economic factors, the social factors, the technological factors, environmental factors, and legal factors. So for example, you are trying to identify are there any possibilities because of the political situation may change which will lead to you end up paying a lot of penalty. Okay. Are there any possibility for the economic condition to change? For the sake of argument, if that's the case, if there's an economic downturn, this is a risk for you to lose your money. So, PESTLE here gives us a framework, okay, for the company of what might go wrong, okay? So after identify what might go wrong from a political perspective, from an economic, environmental, that kind of things perspective, what you're going to do is to come up with some sorts of answers, okay? How to deal with those certain possible risky area. So you can also use some sort of SWOT analysis. SWOT analysis is identify the strength of the businesses, the weakness of the businesses, the opportunity of the businesses, and the threat of the businesses as well. Okay, I'm trying to identify are there any risks or are there any possibilities which will damage our overall strength, okay, within our businesses. So for example, our APC here is specializing in providing the high quality ACCA courses. So this is our strength, isn't it? So maybe there will be a risk or maybe there will be a possibility that we are not going to provide the high quality ACCA courses because our core tutors within our APC gets ill. Okay, so this is a risk, isn't it? So we have to identify that and come up with a solution in relation to that. Of course, another way we can use is to mind mapping or maybe brainstorming. Okay, what this means is that we group some sorts of people into a team. What we're going to do is to discuss what our company does and how many risks the company is facing and how to deal with it. Okay, so this is something to do with our brainstorming. So I hope this does not sound like quite fancy here. So what I'm going to do is to talk about the next one, which is what type of the risks are there, okay, in the real practice. Firstly, it can be general risk. Secondly, it can be financial risk. General risk will include the legal risk because of the change in the legislation that will end up paying a lot of penalty. Secondly, health and safety risk is that, there's a possibility that we are not complying with the health and safety regulation. We will end up paying a lot of penalty. There will be environmental risk. Is the risk, or maybe there's a possibility that I'm not going to comply with the environmental legislation, which will end up paying a lot of penalty. It can be technological risk. Is that we'll think about Nokia. Okay, so Nokia has its mobile phone, but as Apple Incorporation has produced its iPhone, that the Nokia's mobile phone, the sales revenue within the Nokia mobile phone has decreased dramatically because of the technological factors, because of this risk that Nokia sales revenue would decrease to a certain level. Okay, so this is the technological risk. The financial risk, which includes the market risk. So think about the economic recession. So economic recession has made a lot of companies go bust, and their share price has decreased, okay, to a minimum level. Okay, this is quite serious, isn't it? So the market risk here is the risk or possibility that the market value of a particular asset, such as the shares, assets, again with factory, property, plants and equipment, will decrease in its value. Okay, so this is our market risk. So market risk has been examined a lot of times by your examiner, so make sure you're ready for that. So the second financial risk is the credit risk. So the credit risk is the risk that you extend the credit to a customer, but the customer does not pay for you. Okay. So the third risk is the liquidity risk. So the liquidity risk is that there's a risk that there's not enough working capital or maybe cash within your company to pay off the supplier. If that's the case, the supplier may try to force you into liquidation, isn't it? Because you owe the money, but you have no money to pay for them. The next risk is something to do with our currency risk. So currency risk is the risk that will be, due to the change in the exchange rate, which will, make you end up paying more money than original. Okay? So this is currency risk. Beside that, what we're going to do is to look at the property risk. Okay? Property risk here, which is the risk that you lie to others. Okay? That you lie to others so that when you try to ask them for help later on, they might not trust you. And there will be a reputation risk as well. The reputation risk is that there's a possibility that because of your action, which will lead to a decrease in the reputation of a company. So the reputation risk can be linked to the above risk. Okay. So for the risk then, I'd like to introduce a concept called risk relationship. So think about it this way. The risk relationship can be including the positive relationship and negative relationship. Positive risk relationship simply talks about, think about it this way. If you're not going to invest a lot of money into the health and safety affairs, so such as you're not going to invest a lot of money into renewing the machinery of your company, so which might be the case that your machinery does not fulfill the health and safety legislation, which may be a possibility that you have to end up paying a lot of money. And if that's the case, well, this will be increase in the reputation risk here as well. Because you're not complying with certain laws and regulation, you may lose your reputation because you are not honest from the external perspective. Okay, so this is positive relationship. It's that, well, because the one risk has a rise or decrease, which will lead to another risk will be a rise and decrease, okay, on the same side as well. And there'll be a negative relationship, which means, well, if you're going to invest a lot of money into renewing the technology, so think about the Nokia. If he's going to introduce some sort of Android system, such as Google, so if that's the case, well, the technological risk will decrease because they have, some sort of fancy products to compete with Apple Incorporation, isn't it? But there will be also a risk that the liquidity risk will go up, which means there will be a possibility that you end up spending a lot of money and end up having no money within a company because you are, investing a lot of money, all of your money into how to, introduce this Android system. So the negative risk relationship, which means as a risk decrease or increase, and other risk goes the same round. Okay, so I hope you're happy with that. What we're going to do next is to look at the second row of the risk committee, is to assess the risk, or what's called the risk assessment. So how can we assess the risk then? We use a technique called risk mapping. So how's that work then? Well, we can classify, okay, we can put all of these risks into the into this graph, okay, based upon the x-axis and y-axis over here. So the x-axis is the likelihood that the risk will happen into the real practice, and the y-axis is the impact of this risk onto the company. So for example, the risks, so such as we discussed above, is the technological risk. This risk will have a great or significant impact onto the Nokia company if he's not going to renew his technology to compete with other mobile phone providers. Okay, so the impact is so high. What about the likelihood? What about the likelihood of this risk will happen? Well, for the technological risk in the Nokia Corporation, a likelihood is certainly very likely. It's simply because there are lots of mobile phone providers, competitors here to, enjoying the same cake of the mobile market, okay, together with Nokia. So if that's the case, well, due to the technological risk, which will end up for the Nokia company paying lots of money or losing lots of sales revenue, isn't it? It's like, it's almost certain. Okay, it's likely, it's very likely. So, based on the x-axis and y-axis, we classify all of the risks we identified and plot into these diagrams here. Okay, and to do so, what we're going to do, why do we have to do that, is to we have to identify which risks are the most significant and the most likely to happen. Okay, so this is something to do with our prioritizing our risks. Okay, so trying to prioritizing our risks, we're trying to identify which risks we should be able to address firstly, and which risks we should be able to accept lastly. Okay, we're trying to allocate our resources in relation to those risks. So the prioritization of the risks will be depending upon the objective assessment by the risk committee, such as using the statistic from the business analyst or forecasted by the business analyst or newsletter, that kind of thing. We're trying to establish, well, for the economic risk, we'll have to identify whether or not the inflation will be going up next year or not. Okay, so this is the objective assessment. So prioritization of the risks will be depending upon the subjective assessment as well. So subjective assessment, which means, well, it's subjective up to the risk committee to consider which risk is most important, which risk is not important. It will depending upon certain factors. I use a mnemonic called 4A's. Okay, so first A is standing for the risk authority. So for the risk committee, it's board of directors. If they carry out the risk assessment, what they're going to do is that they assess the risks from a company's perspective, not just from the individual department's perspective. So if that's the case, well, if they failure to comply with certain laws and regulations, okay, by the company, if that's the case, the risk committee may try to assess this risk have a significant impact onto the company for the sake of argument of failure to comply with the laws and regulation according to IAS number 37, provisions, contingent liabilities and contingent assets. You're not only to provide some sort of disclose some sort of contingent liability, or maybe you have to disclose, you have to provide for a provision as well, which will increase your overall liability, because your company is borrowing lots of money nowadays, and providing such a provision which will include or increase the expenses in your income statement as well. So this is so significant from a company's perspective, and also this will lead to an impairment of the reputation by the company. So they may try to think that this risk is so significant. Okay, so risk authority here will be very important. Okay, it is simply talking about who does the risk assessment. The next A stands for the risk appetite. Okay, so whether or not you're risk aggressive director or a risk averse director. So if you're a risk aggressive director, you may try to pursue a strategy that is quite risky. Okay, so for the very risky strategy, you're not going to avoid that. What you're going to do is to stick to that. Okay, so this is risk appetite. The third A stands for the risk aptitude. Okay, it simply talks about what to do. Are there any skills and resources for you to address those risks? If the answer is yes, congratulations. But if the answer is no, so what you're going to do is to classify this risk is so significant, so likely to happen, you have no idea to deal with it. What we're going to do, maybe we'll have to think about other ways to deal with it as well. Okay? The last A stands for the risk awareness. So this is something to do with the stakeholders, to see whether or not these risks will affect a lot of stakeholders. And if the answer is certainly yes, what we're going to do is that, well, maybe we classify this risk to be quite significant based upon our judgment. Okay, so prioritization of the risk will be based upon the objective and the subjective assessment. Okay, so the techniques we're going to use in the risk assessment is to use the risk mapping. So what we're going to do is to look at the third row, okay, of the risk strategy, is to set up some sort of risk strategy. So what's the risk strategy? Is that, well, we set up a TARA framework, okay, TARA framework, okay. So there are basically 4 strategies here. So TARA. The first two, which means to transfer the risk by buying the insurance or setting up a joint venture with our partner, trying to share the risk, okay? Share the risk with other persons. What we're going to do next is that, well, we can also avoid the risk as well. But we're dependent upon the 4 A's we've discussed about, okay? We're dependent upon the risk authority, okay? So if you're a risk management, okay, risk committee, which is a board level, what you're going to do is that, well, you may try to avoid any reputation risks that the company is suffering. You're depending upon the risk appetite. So if you're a risk averse director, you will not try to pursue the risky strategy. You may try to avoid those risks. If you're a risk aggressive director, what you're going to do is to pursue the risks rather than avoid it. The next A stands for the risk aptitude. Okay, so if you have a lot of skills and resources and power to deal with these risks, you certainly want to avoid the risk. Okay, but if you have no skills and resources to deal with this risk, you may end up accept the risk rather than avoid it. Lastly, risk awareness. If they affect lots of stakeholders, of course you have to avoid those risks. If it affects only a small number of stakeholders, which is not quite important for the company, why not spending a lot of resources of dealing those risks? The third R stands for reduce the risk. The reduction of the risk will be these 2 ways. You can either pursuing a proactive approach or you can pursuing a reactive approach. Proactive approach, which means you can train your staff, okay, to set up a belief for your staff that seeing that the risks should be reduced, okay. So for the labour-intensive factory, they may try to think that the safety issues within that factory is so important. So any risks that will affecting the safety issues within that factory should be reduced, okay. And this will form a belief for the employee, because the employee has his family. So what if the employee gets hurt? If the employee gets hurt, then the family will suffer a lot, because maybe the father within the company gets hurt. He's not able to work anymore. So if that's the case, he cannot earn money for the family, and the family will suffer poverty. Okay? So this will be a belief for the workers within a company to act safely. So you can also use some sort of reactive approach by improving your internal control system over here. So as long as your internal control system within your company is good enough. So you can, to a certain extent, to prohibit some sort of, fraud and errors within the system. So if that's the case, it can reduce the risk a certain bit. Finally, what you can do, if you have nothing about it, you have no resources to deal with it, you have no idea of how to deal with it, you may think that the risk is so minor it does not happen. Well, the fourth strategy, for the risk committee is to accept the risk. But the question is, how much risk should the company accept? The principle is, well, you can accept the risk as low as is reasonably practical. A LARP for short. So how does that work then? Well, the level of acceptance of the risk will be depending upon the level of risk itself. So if the level of risk is so high, which means there will be a low acceptance, and if the level of risk is so low, there will be a high acceptance. And the point at which is a high risk, high level of risk, here is that, well, we have a low level of acceptance. What we're going to do is to avoid the risk. And if the point at which there will be low level of risk, which will mean that we have a high level of acceptance, we accept the risk. And the area between these 2 points, what we're going to do is to transfer the risk, buying the insurance, or reduce the risk either using the proactive approach or reactive approach. So these are the 4 strategies for the risk committee. So the next step they're going to take is to implement and monitor the risk strategy they set above. So when talking about the implementation and monitoring of the risk strategy, we are talking about the risk management system here. It's a cycle. So what we're going to do is that what we have to review frequently, for the risk management system. It does not mean that we set the risk strategy above and then we can get on with it. No. What we're going to do is that what we have to review, review whether or not it's operating as sound as it should be. But the frequency of the review would depend upon the company's environment. So a company's environment can be static or can be volatile, or dynamic. The company's environment can be static or dynamic. So, for example, for the company's environment is quite static. It's something to do. Some companies like the charity. It's the non-profit making organisation, static. So for some companies, company's environment is so dynamic, such as the IT company or financial service company. These companies are the environment is so dynamic. And what this tells us is that, well, the new risks associated with the company will be so frequent, and the impact of the risk for the company may change from time to time. So what we're going to do is that, well, for the risk strategy here, during the implementation and monitoring of the risk strategy, will be updated as the environmental changes as well. So these are the 4 roles for the risk committee. What we're going to do is to conclude our section on risk management. We're talking about, do we need it? The answer is it depends. And secondly, who does it? It's the risk committee does it. Firstly, we have to consider its composition requirement, and secondly, is their roles of the risk committee.
Into 3 parts. We're going to talk about what crisis management is, why and how you can create a plan and why it's necessary to plan for a crisis, and if you should be unfortunate enough to find yourself in a crisis, what is the best way for you to respond? All right. So what is crisis management anyway? Well, I think to understand crisis management, we first really need to talk about what, in fact, is a crisis. A crisis is a show-stopping, people-stopping, product-stopping, reputation-defining situation that creates victims and or explosive visibility. So it's not a good thing. And unfortunately, we are all vulnerable to crises. It does not matter whether you're a very small company or a very large company. We are all vulnerable to it, and we need to plan in order to respond as best we can when we find ourselves in such a situation. But again, it's really important to, excuse me, to understand what's in crisis. If it's not people stopping, show stopping, then it's an issue. If it's less than a crisis, it's really a problem or an issue, and it's going to be handled differently. Now, if you've got an issue and it's not managed properly, an issue can certainly quickly escalate into a crisis. But crisis management is specific to those very big, explosive situations. All right, a formal definition of crisis management. Crisis management is the process by which an organization deals with a major unpredictable event, unpredictable being the key word, that threatens to harm the organization, its stakeholders, or the general public. The reason we're here today is to talk about the fact that even though we can't always anticipate a crisis, we can predict potential crises that might affect our particular company or organization and plan for that accordingly. There are three elements that are common to any crisis, and these are that a crisis poses a threat to your organization, a threat in some manner, whether it's a threat to your employees, a threat to your financial viability, to your product credibility. Those are all threats to your organization. A crisis always has an element of surprise. No matter how well we plan for a crisis, they still manage to take us by surprise. The good news is that we plan properly, we can react to them well, even when we are taken by surprise. The other thing about a crisis is that it requires a very short decision-making time. When you're in the midst of a crisis, you do not have time to waffle. That's when you're really getting in trouble. So a crisis happens. You need to be able to be very decisive. You've got a very short window of opportunity to make things right and communicate well and to mitigate the damage that this crisis is going to have. And again, that's another reason that you want to really plan. When a crisis happens, everybody goes into a bit of shock. There's that deer in the headlights reaction because it's taken you by surprise. You're scared. So if you planned for this, you don't have to think a great deal. You can just reach in and get your crisis plan binder, open it up to the particular scenario that's happening to you, and all of the ways in which you're supposed to respond can be laid out for you. All right, there are different types of crises, and the reason we talk about the different types is that different types require different sorts of response, and some are harder to deal with than others. The graph that's showing you there is that the good news is that 95% of crises that typically befall a company or organization are operating crises, and these are good because they're the easiest ones to control. What's an operating crisis? Well, an operating crisis is anything that involves how the company operates every day. You know, your machinery, your computers, your processes and protocols and electricity, and it's literally your day-to-day operations. If you're a manufacturing facility, it has to do with your trucks and your distribution and so forth and so on. Well, any of us have a lot of different aspects to our operations of our company that are vulnerable to a crisis, but those are the things that we feel most comfortable with. It defines our company. It's how we work. So we're typically in a position where we can handle those crises better than the non-operating crises. that constitutes about 5% of the crises that threaten an organization. Unfortunately, these are the ones that can be the most damaging. A non-operating crisis is like a bomb threat, congressional action against your company, embezzlement, violence in the workplace, ethics problems, extortion, criminal activity, major theft, litigation, someone sues your company, sexual harassment, a dramatic drop in your stock price, whistleblowers, all of those are examples of non-operating crises types. Now, the third category of crises is one that's a combination of the two or more. There are crises that certainly can be both operating and non-operating and at the same time. That's no fun either. Then the fourth type is a disaster. And a disaster meaning it can either be a natural disaster or an accident of some type. Obviously, since we're here in Wilmington, we're quite vulnerable to hurricanes. So all of us should have some sort of a crisis plan in place for what we do if we get hit by a major hurricane. But it can also include like a power outage, a fire, flooding, hazardous material spill, those sorts of things that one can anticipate. The fifth type of crises is insidious, unethical behaviors. Again, these are sort of subtle, unethical behaviors that can go on in the workplace, and if they are under the radar, they can really cause harm when they kind of hit the radar. So if you're in a position to identify any of these types of unethical behaviors in your workplace, you are definitely going to want to immediately address these, because that's a risk or an issue that can definitely escalate into a crisis. Examples of this would be leadership within your company that allows supervisors to overlook bad behaviors or lax safety protocols, management that allows shortcuts to take place, management that ignores signs of questionable behavior like sexual harassment, that type of thing. A management environment or a leadership environment that belittles or humiliates those who suggest or seek ethical standards. These are all unethical behaviors, and there are many, many more, of course, that really need to be rooted out and dealt with immediately, because they can become those types of non-operating crises that really threaten your company. The sixth type of crises is virtual. And, of course, we talk about social media and the Internet here all the time, and the way in which communications vehicles have rapidly evolved and changed over the past few years. So a virtual crisis is a really threatening crisis, because, we all know that rumors, bad news, news of unethical behavior, an industrial accident, the plane going down in the Hudson, they go around the Internet like wildfire, and they can spread so quickly that, again, the way in which you plan and respond for that is unique to that particular crisis. All right, crisis venues. Crises can take place in a variety of venues within your company, and again, it depends on your company's size and type and so forth. But if you're a larger company, or say an industrial or a manufacturing facility, you're typically going to have like a plant location, then you're going to have your corporate headquarters. So it is different if the crisis is actually happening in the plant, or is it happening at headquarters. Is the crisis one that is involving and taking place only among top management, or is this something that really impacts the entire workforce? A crisis can be local. and so you're really trying to mitigate and control the crisis so it doesn't spill over and grow into something that's going to be more of a regional or a national or even a global scope. And obviously, the bigger the venue, the bigger the response, the more aggressive your communications need to be. And then the other venue, of course, is the virtual venue where everything's kind of running around on the internet through the blogosphere and so forth. And again, that one can start virtually by sort of a blogger who really has a beef with your company and is really spreading negative sentiment about your company online. All right, we've talked about what a crisis is and what is crisis management. Now let's talk about planning for a crisis. Why plan for a crisis? Well, it is not the most pleasurable part of a lot of CEO's job or top management. Typically everybody wants to move forward and look into the positive things, but you really need to plan. If you don't plan for a crisis, you can assure yourself that if one befalls you, you are probably going to handle it poorly, and it's going to grow into a much bigger problem than it could have if you'd been ready. So why plan? Well, it enables you to have a very conclusive, effective first response. When you're in a crisis, people need you to communicate with them immediately, people being your employees, your stakeholders, your stockholders, your vendors, your customers, the media, the community in which your company is located. And without planning, it's very hard to get that first response out there quickly and with assurance. And by planning, it provides you with that first response that's going to have the appropriate impact. Planning also provides you an opportunity to get senior management involved in the process. You cannot do crisis planning without senior management buy-in. If you're doing crisis planning without their express approval and participation, you should stop, because it's going to be a waste of your time, because when you go to put that plan into practice, they are going to question it because their reputation and credibility is on the line, and unless they already know what the plan is, they're not going to feel confident in letting you move that forward, okay? A plan also gives you what we call pre-authorization. Again, by getting senior management to buy in right at the beginning, they are going ahead and pre-authorizing you to implement that plan when and if you need to. Planning also enables you to prepare for victims. With most crises, there are victims. Now, I'm not saying that like they're come to physical harm, although some crises can cause damage in that manner, but victims can be your employees, victims can be your stockholders, victims could be just a couple of key management folks. It can be the families of your employees. So, as you're planning and anticipating all these different scenarios that could impact your business, you're always thinking about the victims in the planning process. Okay, if this happens and these people are victimized, what are we going to do as a company to help them during this time? If a hurricane shuts down our company, what are we going to do to help our employees get through this time? What are we going to do to help their families? And helping victims and preparing for victims is one of the best ways to mitigate that negativity and damage to your company reputation. Planning also prevents collateral damage. And what I mean by that is you can have a crisis, you can respond very well to it, and you can shut it down quickly, mitigate the impact, but if you don't plan, a crisis, even a small crisis, can quickly balloon into a big major crisis, and therefore having a lot of collateral damage to your company and your reputation that maybe you didn't really need to have if you'd planned properly. And the other good thing about crisis planning, and a very important point for you to sell to top management to enable you to do it is that it reduces the vulnerabilities that your company is going to face. In crisis planning, you're really trying to anticipate what is the worst case scenario and what are all of the worst case scenarios that can befall our company. And so when you're going through all of this scenario planning, you can often unearth vulnerabilities in your company that you can go ahead and address right then and build a stronger company and reduce those vulnerabilities. And crisis planning also puts you in a position where by doing all of this self-examination, you are really setting up very good, strong standards and protocols for appropriate behavior in the workplace, appropriate ethical behavior, professional behavior, and so forth. And so it puts you in a position where you are strengthening your reputation, and you're really in a position where you have unchallengeable behavior standards in your workplace. All right, we're going to get into the specifics of creating a plan in just a moment. One of the first things that you need to do in crisis planning is you want to identify the threats. What are those big fat cats that are going to be chasing me, that are going to threaten my company and the viability of our workforce? So what are your vulnerabilities? What threats exist? And again, remember, it's really easy as you're going through this process of identifying the threats, break it down into the types of crises that we just talked about a moment ago. Break it down into those categories, and that really helps you in your thinking process and your planning process to work through what are all the possible operating threats that could happen. What are all the possible non-operating threats? And you may come up with a lot. I mean, there's no magic number. If you brainstorm 100 potential threats to your company, that's great. Put them all down, record them. And then the next step is that you want to prioritize them, okay? So let's say that, just for sake of discussion, you identify 100 threats, potential threats to your company, which isn't an unrealistic number when you factor in natural disasters and operating, non-operating, and so forth. But what you need to do is you really need to prioritize them. And a good way to prioritize them is to rank them in terms of 3 different characteristics. What's the likelihood of that threat happening to our company? What is the impact of that threat to our company? Is it a really high impact? Is it a low impact? What's the potential there? And then you also want to look at the collateral damage that threat can pose to your company. What's going to be the additional fallout beyond just the immediate pain? What's going to be all the additional ancillary pain that threat can pose to us? And what you want to do is every threat that you identify, let's say it's a hurricane, just for discussion. Well, the likelihood of a hurricane in our community, I'd say, is a 2, so give it a score of 2. The impact, again, depends on the strength of the hurricane and your vulnerability and location and such. I'll give it a 2. The collateral damage, I'm going to give that a 1. So you add those up, then the threat of a hurricane is going to have a score of 5. And you literally want to go through and give a number to each of those threats so you can identify what are the top that have a score of 9, that are going to be the most threatening, most likely to happen, biggest impact, and most collateral damage. All right, so these are the steps for actually creating a plan. The first step is the visibility analysis, which is really, it's just another title for what we just talked about. Visibility analysis is identifying threats. What are those activities and events that could put your company in a position when you are highly visible to a threat? Okay, identify your threats. The second step we just talked about as well is prioritize your exposure. Analyze the threats by likelihood, impact, and collateral damage. And the way that we do this is we get our client, that again, you got to have senior management, you got to have the head of the company in that room, and you want to have your communications person and say your operations person. You want to have your leadership team in that room, and it's a brainstorming session. And we brainstorm what are all the different threats that could befall your company. And then, okay, so we've identified 100. Now we're going to go back. We have them all up on the whiteboard. And then we're going to go through and we're going to give them each a number. And we're going to rank them by likelihood, impact, and collateral damage. And let's say that through that process, we then identified the top 10 threats to the company. The third step is scenario development. Okay, you've identified the top 10 threats to the company. Then you need to work out a scenario. Well, what's the impact going to be? Okay, if I've said that I'm a daycare center, and one of my top threats to my company is swine flu. All right, so I need to work out the scenario on paper. You want to capture all this information. You don't want to just talk about it. Because at the end of the day, you want to have a crisis plan that's in a binder, that's close by. When your crisis comes, you can pull that baby out. You can flip to scenario C, which is swine flu in my daycare center, and it's going to tell me what I need to do. All right, so scenario development. I've got a big swine flu outbreak at my daycare center. What's that mean? You know, how is that scenario going to play out? So do that exercise again with the management team or whomever is assigned. You don't have to have your key leadership team in the scenario development process. That can often be more appropriately handled by, again, your communications marketing person, maybe an HR representative, and you know, it can be a smaller group to really kind of work through what are the different scenarios that could happen. And then you want to develop messages that are that you're going to use for each of those unique scenarios. Messages to employees, messages to the media. You want to literally craft out press releases and statements to the media. If swine flu there should be a significant outbreak that impacts more than 50% of the children here, the message that we are going to be sending out to the parents is X. The message to the media is this. The message to our employees is this. You literally script those messages out, and again, if and when that should happen, you've got that plan. You flip to that scenario. You've already got your messages that just need to be fine-tuned to the particular incident, and then you're ready to be able to communicate. The next step, a very, very important step, is you need to have your contact list. Okay? Crisis planning is all about having a good contact list. A crisis impacts a lot of people, so you need to communicate to a lot of different people. You've got a lot of stakeholders out there who need to hear from you. So you've got to have your media list, your employee list, your stakeholder list, your neighbors list, customer list, because you do not have time in the middle of a crisis to put these lists together. They have got to be a part of your plan, and you've got to have a really quick, easy way to disseminate that information to them right away. Another very important part of crisis planning is the media training. There should be one spokesperson for your company for any given scenario. Okay, now that spokesperson could change depending on the scenario. Maybe there's somebody else in your company who should speak to the media or employees if it's a hurricane versus if you have a product recall. But whomever that spokesperson is that's going to be out there communicating on your behalf, they have got to go through media training in advance. You do not want them to get their media training on the job in the middle of a crisis, because that's when big mistakes can happen, and you want to make sure that your spokesperson is very comfortable and ready for whatever comes at them. The seventh step is you've got to really test these plans. It's one thing to have a great crisis plan and have it in a pretty binder and have all these messages and scenarios developed and contacts. But if you don't test it and go through a drill, you may not realize that there's a real weak link somehow in this plan, or that there's a very important audience that you overlooked, or that your spokesperson just isn't as ready as you thought they were going to be. So once you get your plan in place, have a drill. You don't need to shut down the whole company. You know, you can do what we call tabletop drills, where you've got like your core team and you're kind of just working through the scenario and testing some of the messages and how things resonate and so forth. And the last step with your plan is don't let it collect dust. In order for your plan to be effective, it's got to constantly be updated, and you've got to constantly be educating the people within your company as to what role they play in the implementation of this crisis plan. Things change so rapidly, technology changes so rapidly, your contact list is constantly changing and developing and growing. You know, if you had created a crisis plan 12 or 18 months ago that didn't incorporate Twitter, for instance, or some of the newer social media vehicles that everyone's using now, then you really want to look at that and re-examine. Now, how can these new communication vehicles be employed in this crisis plan to keep it up to date and make sure that it's most effective? All right, what are the keys to successful planning? Well, again, I will keep saying this, you've got to have your top management buying into the process. You need to create your communication strategies by scenario. Crisis planning is a scenario-based plan. A crisis plan is ideally housed in a binder that has tabs that identify scenarios 1 through 10. And the response strategies that you have are by scenario. You cannot respond to the same way about swine flu as you're going to respond to a hurricane impacted the company, to how you're going to respond to the CEO just got convicted of insider trading or embezzlement or sexual harassment. They really need to be strategy by scenario. Your plan has to have activation procedures in place. People need to know, when is a crisis a crisis? When does the crisis plan actually kick into play? That can often be overlooked because it can be hard to identify, is this a problem or is this a crisis? But if you should always defer to it being a crisis because, again, you want to mitigate any negativity right away. Another key to successful planning is what we call headquarters if. And this can really, this is probably more pertinent to larger companies. And what this means is if you've got a lot of different folks out there in the field, or if you're a manufacturer that's got different plant locations, there are going to be different activities within these different groups and locations that there might be a crisis brewing in a plant location, but if they don't call headquarters and let them know about it, then it can quickly mushroom into a big problem that could have been mitigated. So you need to, again, articulate in your plan, when do you call headquarters? When is it appropriate? And, you know, making sure that you create an environment where it's okay to call headquarters with these sorts of issues. Again, corporate level buy-in, you want people, if you're a manufacturer, you want people at the plant level to buy into this too. You've got to do a lot of follow-up and updating of your procedures in the plan. Again, the installation testing and effectiveness programs, and website readiness. This is really important. When you're going through your crisis planning and you have a really big potential crisis that is going to generate a lot of questions from consumers and customers and the media and so forth, you may want to go ahead and create a website that's an information portal for all these different audiences should this crisis occur. And you create this website, but it's just a dark site, meaning it's not up and running. Okay, programmed, it's ready to rock. All you got to do is really flip that switch. Should that crisis happen, it's up there, and you've got a really effective communication vehicle to disseminate information to a huge global audience right away. And again, you don't have time in the middle of a crisis to develop this type of mechanism. It really needs to be done as part of your crisis planning. All right, when are you ready for a crisis? Well, this divides kind of the key components of that readiness equation into a chart. And believe it or not, 50% of your energy to be ready for a crisis needs to go into accurate contact information. So don't discount the importance of that. You could have the best laid plans in the world, the best messages crafted, but if you can't get them out to the appropriate sources and contacts in a very expedient way, your crisis plan is going to be crippled. 25% is about scenario preparation and testing. Again, identifying the threats, creating the scenario, preparing messages and responses, and testing that. 20% is making sure that you have gotten the pre-authorization from the powers that be in your company to disseminate that press release. For instance, how we mentioned earlier, you want to have press releases already drafted and approved way before a crisis happens. You cannot be running with a press release to your CEO looking for their approval in the midst of a crisis. You want to have all these tools and messages pre-authorized in advance so that when it happens, it's out there and you're able to respond really, really quickly. 5% of your readiness is never, you're never going to be completely ready. You can be 95% ready if you're a great planner, but 5% is always just going to be the element of surprise. There are things that have the best laid plans. There are aspects to any crisis that are 100% unanticipated, and things can get away from you, and you've just got to be really quick on your feet and ready to respond. Which leads me right into the next part of our presentation is how do you respond if a crisis should befall your company? Well, there are some triggers. Again, like I mentioned earlier, it can be really difficult to determine, are we in a crisis? Are we not in a crisis? What really triggers that putting the plan into action? Well, it can be a variety of things. You can have someone in your company that is responsible for making that determination. You can call him or her the crisis czar. You can call him the CEO or the director of marketing, whoever that person is. There should be a point person that is able to identify when, in fact, it's crisis mode in the company. And again, that could be senior management. You need to get once it is triggered that you're in a crisis, senior management has got to be brought in right away. They have got to know everything that's going on because they're the ones that are really at the front lines of the communications and that need to be in a position to reassure and inform. Companies often have a special response unit that exists and is ready to be put into action should a crisis occur. For instance, again, going back to the hurricane analogy, Progress Energy, I know from personal experience, is certainly very well versed in hurricane response, and they will have their special response units in play right away, linemen out, getting the power back on. And companies can also have what's called an incident command, like command center. When you're in a crisis mode, you've got to have your brain trust around you. You do not want everyone scattered here, there, and everywhere. You want to have communication centralized. You want to have your PR and marketing people very close to your CEO or whomever the spokesperson is so they can be advising him or her. So a lot of times having kind of a command center either within the company grounds or a convenient location where you've got access to, computers and technology and communication vehicles is really important. Sometimes companies call upon call centers to help them. If there's, like for instance, we've all heard quite a bit about different product recalls that have happened, whether it be peanut butter or the spinach crises or what have you. And when there is something that happens on that scale, then you've got a lot of consumers who are going to be calling in with questions about their level of risk or what they need to do to return the product, that type of thing. So call centers can be very, very effective to help a company, again, no matter how big or small, handle that volume of inquiries. What are your response priorities? Well, the first hour, after you know you're in a crisis, it's what's called the golden hour. Careers are made or lost in this golden hour. That is when you've identified the problem and you are prioritizing and identifying how you're going to respond. You have to stop the production of victims. That is immediate. You have to resolve the problem promptly. You need to begin addressing key issues. Sounds like a lot that needs to happen, and it is. There is a lot that needs to happen right away, very quickly, lots of communications to lots of different people, and that's why planning is really important. So a rule of thumb is if it's leaking, foaming, smoking, burning, creative victims, you need to deal with the underlying problems first. Second, you want to manage the victim dimension. Again, like we said earlier, almost any crisis is going to have a victim. And victims, unfortunately, are, they can make a issue or a crisis become very, very big because they can communicate very quickly to large audience. So we need to mitigate that. Victims are people, animals, or living systems, and victims often feel angry, frustrated, and kind of feel isolated or alone. And really what victims want is they want a platform to vent that frustration, and they want some visibility, they want to feel vindicated, and they want an apology. So we need to manage that victim dimension and get it under control quickly so it doesn't get out of hand. Third thing, you want to communicate to your employees. Do not overlook your employees. They are your company. They need to know what's going on. You want to inform them, educate them, script them as necessary. If this is a crisis in which their friends and family and acquaintances are going to be posing a lot of questions to them, they need to know how they're supposed to respond. Use the 75-word rule. 75 words is typically approximately 30 seconds spoken. So you want to disseminate 75 words every hour or as needed. Give employees information so they'll stop speculating. You do not want to wait until you have all the information in hand. You do not want to wait to vent every single thing through your lawyer before you communicate to your employees. It may meet the standards of the court of legal court, but it will not meet the standards in the court of public opinion. And when you're in a crisis, you're in the court of public opinion. Do not let your lawyers hijack your communications. You've got to communicate, and you've got to communicate quickly. Fourth thing, you need to make contact. Contact those people indirectly affected. Inform your neighbors, regulators, governments, friends, allies, families, relatives of crisis. Again, that's where that contact list comes into play. And you need to get out there and inform them right away. Fifth, put out the fire. Deal with the media and or individuals and organizations who will use the crisis to further their own agenda. Okay? Really important to do that. All right, we are coming down to the conclusion. We're going to be taking some questions, so go ahead and put those questions in there if you haven't already. All right, a big part of response is you need to communicate out there. You need to address everyone's concerns, but then, the fallout of a crisis is that oftentimes you have, whatever the crisis might be, it has created victims. It has possibly tarnished your company's reputation. So you need to really be very proactive to rebuild trust with all of your different stakeholders, and you really need to start to seek and obtain forgiveness. This is not a very quick process. What you need to do, however, to rebuild this trust and seek forgiveness needs to be done quickly and consistently, and you need to be patient because sometimes, depending on the crisis, it can take a little while or a long while to regain that trust. The first thing is candor. You want to be very frank and honest and open with everybody that you're talking to that a problem exists. That is the number one thing. Do not dodge the problem. Go ahead and be very honest that, yes, we are in fact in the middle of a crisis. There is a problem that exists, and there are people or the environment or public trust. There are people and groups and entities that are being affected, and we are working hard to understand and mediate the situation. The second is the infamous apology. We have all heard over the past 5 years there have been more corporate apologies out there than we can shake a stick at, but it's a very, very important part of this process of regaining trust. You need to apologize about the crisis. You need to be able to express personal regret, remorse, and sorrow. You need to acknowledge personal responsibility for having injured or insulted or failed another person or group, and accept responsibility and promise to make amends in return. The third part is an explanation. People really want to know why this occurred. Why did the problem occur? Give us some information and let us know how this happened. We want to know, the public wants to know the underlying reasons or behaviors that led to the situation. And again, even if you've got partial information early, just give the information that you have. Oftentimes, so many companies make the mistake of wanting to know the whole entire story before they tell any part of the story. Go ahead and explain what you know when you know it. Affirmation. This means that you really want to talk about and communicate what you've learned from the situation and how it's going to influence future behavior in your company and among your employees. And you want to definitely commit to regularly report any additional information as it comes out and when it comes out. Declaration. This is really you making a very public commitment to take positive steps to address the issue and resolve the situation. Okay? They need an apology, they want an explanation, they want to know that you've learned something, and then they want to know, well, what are you going to do about it? What are the positive steps that you're going to take? Number 6 is probably one of the most difficult steps for a lot of business owners and business leaders to do, and this is contrition, because it is very difficult for a business owner or leader to admit that perhaps their actions or the actions that they are responsible for overseeing led to this particular problem. But this is a really, really important step. If this step is not taken, all the other steps are really moot. So this means that you've got to continuously verbalize regret, empathy, sympathy, even embarrassment if the particular situation calls for it. Take appropriate responsibility for having allowed the situation to occur in the first place. A lot of times business leaders think that they are not responsible and therefore they do not want to act contrite. But as the leader of the company, they are ultimately responsible, and therefore somehow they allowed it to happen, and they need to take responsibility, and they need to communicate that responsibility. 7th step is you really want to involve all the different people that have been impacted by this crisis, and you want to consult with them. You know, talk to the victims, talk to the government regulators, talk to the community in which this took place, or independent folks, and let them share with you what they think this, you know, what their impression of the impact was. And what that does is you're really kind of involving them in the process and co-opting them into your process of moving forward and showing them that you care and that you value their opinion. Number 8 is commitment. You need to publicly promise that to the best of your ability, a situation like this is never going to occur again. The public needs to be reassured that you're committed to making sure that this does not happen again and that you will take whatever steps you need to make that happen. And number 9, the last step, is restitution. Find a way to quickly pay the price for the crisis. Now, every crisis has a price. It doesn't necessarily have a monetary price. But again, victims come with a price. And what you need to do is identify what is that price and how can I make restitution? What is required of me? And what you want to do is you want to identify what the expectation is for restitution to pay that price, and you want to go above and beyond that. If the community, if the victims, if the employees are expecting you to give 100% to make this right, give 125%. Nothing will make that crisis go away quicker than restitution, and to do that quickly and well. All right, what are the barriers to success of a crisis management plan? Well, a resistance within the company to call headquarters if. You need to make sure that your employees are all very comfortable and encouraged and rewarded for calling headquarters if there's trouble brewing. It doesn't have to be a crisis. They should call when it's a problem, and then you can mitigate it and it doesn't turn into a crisis. Another barrier to success is competing response priorities between divisions. Again, larger company, you've got different divisions with different priorities. People are busy. This crisis is looming, but then they're also dealing with the fact that they've got a broken down truck, or an employee didn't show up. So you've got to, you're competing with other priorities within the company, and you want to make sure that your crisis gets to the top very quickly. Another thing is that there's often other existing crisis plans within the company. Government regulators and other entities will often require that a company have a crisis plan in place. So unless your top management has been very involved in your crisis plan process, they may think that the government required or the pre-existing plan takes precedence over yours. So you need to identify any other plans that are out there and make sure that yours has top priority. Again, the relationship between corporate and plant locations, need to make sure that this is addressed. There can be turf issues, confusion about who's responding when. If you're doing your planning properly, these should all be addressed early on in the planning process to make sure that doesn't happen. And again, management may have a response plan that they think is the one that's going to go into play. But if you had bought them in at the very beginning and got them to pre-authorize everything, that's not going to be a problem.
We are now on the third pillar, the pillar of law and the rule of law. It's a very delicate subject to deal with. It's a complex subject to deal with, and it is quite abstract as well in trying to recognize what the elements of rule of law and law involve. So if we have to look into our presentation and see the following slide, one of the aspects that we have identified earlier on in the definition of the World Bank, provided by the World Bank, was that all the good governance principles have to be adopted under the ambit of having the rule of law. In fact, our diagram depicts 7 good governance principles, and we're having the legal compliance aspect and the rule of law as the frame around these good governance principles. The rule of law, as explained earlier, is an abstract concept. It's difficult to define, and you probably will not manage to find the definition of what the rule of law is. However, there's a whole plethora of descriptions of what the rule of law actually entails. And amongst the various descriptions that we can find in terms of what rule of law is all about, one may easily identify and understand rule of law by looking at the final point of our slide, which is nobody and nothing is above the law. And when we're dealing of that, when we're saying that nobody and nothing is above the law, what we're actually referring is that laws apply equally and fairly to anyone, whether you are a citizen, whether you are the government, or whether you are a business. The rule of law does not apply to the citizens alone and the businesses as described earlier, and not only to the institution as such of government, but also to the public officials that are actually employed within government. So what we're talking about here is that the law is there equally applied to all, and that you do not have somebody who is above or extraneous to that aspect of law. We shall now look into a description of the rule of law with a very, very short video clip, which I think gives a very concise description of what we're talking about.
Well, the rule of law, some people aren't sure what the rule of law means, so one has to define it first. The rule of law means that all actions and all power ultimately is under the law. The rule of law means that above everything, above the rulers, is something. They aren't the rulers, they are under law. The king is under the law. The crown is under the law, and that is the rule of law. In the end, everything has to answer to some nebulous laws. And that is an extraordinary situation, because in all other civilizations, the rulers have, after a time, they may at first, as they gather power, have said, we make the laws and we keep the laws. After a time, they forget the second statement, that we keep the laws. They become above the law, so that the law doesn't rule them, they rule the law. So they make pronouncements. You can see this in Stalin's Russia, in Chairman Mao's China. You can see it in many, many cases in France under Louis XIV. Again and again, the powers that be get above the law. They have a different law for them. There's one law for the very powerful and rich, another law for the people. So they are above the common law. Only in this funny island, and to a certain extent in Holland, at a certain time Scandinavia, and other countries usually go through phases when they do this, but they usually forget it for all sorts of reasons. Only in this funny island, over about 700 years again, have we believed that ultimately above everything is the law. And even the king has to abide by that, and certainly his ministers, and certainly the church, and everybody is under the same rule. It's like a game of football. The rules of football stand above the individual players, and you ultimately, if you don't abide by them, you are thrown off the field. It's the same with the English legal system.
So, we've seen the concise definition provided by our colleague. So, rule of law, if we have to further describe what rule of law is we're talking of a set of laws that govern society, and that these laws are applied consistently and are equal to everybody regardless of the status. We also have a further description of what rule of law, which elaborates further on, is that it is a legal principle whereby law should govern a nation, as opposed to that the government governs a nation. The government is there to apply the law and to set policy, but it is the law that actually governs the nation, and that is the key principle of the rule of law. Then we have another aspect of our description of rule of law, which applies that it is primarily refers to the influence and the authority of law within a society, particularly as a constraint upon behavior, including the behavior of government officials. So here we're talking that the rule of law is there to actually put everybody into check and follow certain rules. The final context of good governance is that the presence of the rule of law is a fundamental frame that acts as a gel to keep all the other governance principles together. So if we had to refer back to the diagram that we had before, where we had the 7 elements of good governance, and then we saw the frame around those principles, the rule of law is there to actually make sure that all those elements are tightly knit together and do not move away from the core concept of having good governance. The United Nations came up with its own description of rule of law and how it applies in terms of governance. In fact, the United Nations actually start off by saying that the rule of law is a principle of governance. And I think it's a very critical and key description that is provided by the United Nations, which puts everything into context within the context of having good governance. Now, the rule of law requires not only good governance, but it requires the best good governance possible. And here, the rule of law sets out the separation of powers that we dealt with a bit in detail within our modules, which we had previously, whereby we have the legislator, the executive, and the judiciary, which are 3 separate entities, but which each of them act as a check and balance on top of each other. And none of these 3 is above the other. So this makes sure that the maxim of saying that the law is equal to all and nobody is above the law, and nobody meaning also institutions, with the 3 separation of powers, that notion is actually implemented. So the separation of powers and the laws themselves create structures which preserve the rule of law. These structures are fundamental in the mechanics of good governance, and these structures cascade all throughout our country's institutions, including local government. Malta's governance structures around local government is quite comprehensive, whereby we have a high element of institutions or structures which actually have a check and balance function, whilst we also have, obviously, the body of laws that actually determine what the principles of good governance are. Primarily, one of the most apparent aspect of good governance is the aspect of accountability, where within the various body of laws that we have, accountability is a very, very strong protagonist of each and every law. The local context provides a very strong attempt in order to preserve the values of the rule of law. And the regulatory framework around local governance is, I think, an example of how the principles of good governance are actually looked into quite elaborately in our legal context. So, the rule of law and governance. So let us, for a moment, stop and look at the structures and the legislative policies that are around us in terms of local government. Let's start off with the legislative policy. So we have bodies of law, like, for example, the Public Administration Act, which is the act which regulates all public officials and public institutions within the executive arm of government, and excluding, however, the judiciary aspect and the legislative aspect. We have the Local Councils Act, which obviously is the center point of our local government. We also have a number of aspects which are, so to speak, soft law, like the Code of Good Practice for Local Government, whereby there are a number of initiatives that are highlighted in the Code of Good Practices, which are intended to provide a clear guideline for all the local council stakeholders, be it councillors, executive secretaries, or even the employees, on how to deal with various elements of good governance. We also have the Code of Ethics for councillors, which primarily deal with the good governance principle of integrity and accountability. Whilst we also have a quasi-judicial structure, which is that of the Local Governance Board, which is there to act as a check and balance on local government. On the other hand, from a national level, but which affects local government, we have policies that, and laws that relate to having a code of ethics for public officials, which is a key element within the Public Administration Act. We have also the Public Administration Values, again, which is a subset found within the Public Administration Act, which determines government's view of the values that all the institutions within government and its public officials should be working upon, and should be their ethos in the way how they either deliver their services or act as regulators. In our case, this would apply for local government in the way how we actually deliver the services. Then we have the other aspect, which deals with public procurement regulations. It's another legislative policy. Actually, it's more than a policy, it's more of a legislative framework that actually governs the way how we actually go about procurement. And I'm sure all of you are quite in tune and in sync with the public procurement regulations, because they deal with your everyday operations within your council. So, having said that, we have a whole framework of legislative aspects and policies. And last and not least, we should not forget that there is one particular law that is part of the civil law, actually, which is the Code of Operations and Civil Protection, Civil Procedure, excuse me, the COCP. It's Article 469A, which deals specifically with the elements of how procedures are applied and if they were applied appropriately. And they act as a further check and balance. This law acts as a further check and balance on the operations of each and every council. So, apart from that, we have the structures that underline good governance in local government, in order to make sure that the good governance is actually implemented and is preserved. So, which are the institutions which actually look into good governance? There are a number of them. The slide highlights the most critical ones, but there are more to those. So we have already mentioned that there is the Local Governance Board, but apart from that, we have the Department of Local Government, which also has a monitoring function as attributed by the Public Administration Act. We also have the National Audit Office and the Public Accounts Committee, which have a role of scrutiny in terms of the operations of any entity, including that of local government. We also have the Public Service Commission, which looks into the aspects of recruitment and employment, and on how employees are actually managed. We have the Office of the Ombudsman. It's an institution which is there to actually assess if fairness is actually applied primarily in the way how we are taking our decisions. We also have the Internal Audit Directorate, which can conduct sporadic checks on the operations of the local council. So all of this brings to the fore that there is quite an elaborate and overarching structure within government that deals specifically with local government. And it's not maybe, as third parties may assume to be, that there's only the local government department which is there to oversee what the local council is actually doing. It's a quite intricate structure, which could be also a bit daunting for executive secretaries, for instance, to deal with, because you can have so many of these institutions coming in at the same time, looking into the same documents and in the same procedures. But these are fundamental principles that are important to have and preserve good governance, even at a local government level. So, as a conclusion, locally we have the structures in place, we have the legislative framework in place, we have various codes and principles to provide us with guidance. However, good governance is a result of a way of being, in doing what is right and in the right way.